We only cover the first section in this chapter because the other relevant sections we covered when we did our time value money computations. So we just do section 1, which deals with credit cards. And credit cards are hugely relevant in our society. So it's good to understand how the banks are able to charge you interest or finance charge on your purchases. So how a credit card works is that you'll have a credit limit up to a specific dollar amount that you can access. You don't have to obviously take it all. You can do small charges. And then you'll receive a monthly statement that's going to detail out all of the charges that you have with the dollar amount, the date, and who you paid. And then there'll be payments that'll be applied. So your charges are going to be debits to your account. And then your payments, or if you made any returns and they credited that account, those are credits. So make sure you kind of pay attention to which way those are going. And then what the banks do is they calculate an average daily balance, and that's what they're going to be allowed to charge you interest on. Assuming that you didn't pay your balance off in full at the end of the month, they will calculate that average daily balance and then charge you a finance charge. So how we set it up and how the textbook sets it up is like almost like a table. So you're gonna start with your billing date. So whatever date, my example on this slide is it's March 3rd. So March 3rd is your statement date. You'll have a balance because again, like I said, you didn't pay it off. So whatever your starting balance is, and then you'll look to your next transaction to say, okay, well, how long did I have that balance for? So if my billing date is March 3rd and my next transaction wasn't until March 12th, there would be 9 days. So then you take the balance on March 3rd, multiply it by 9 days, and then that's going to be your weighted total for that particular line item. Then you go down to March 12th and you look and see what happened on that day. Did you increase or decrease your balance? How long was that outstanding? And then you'll have a total there. So then you'll do that for each line item. So again, we're trying to build this cumulative balance. Then when you get to the end, you want to make sure that you've accounted for all of the days that are in that month. So like say in that example, March has 31 days. So if your statement starts on March 3rd, it's going to go all the way till April 3rd. So you want to make sure that you account for all 31 of those days. And as you're mapping it out in that table and you have your days outstanding, you can total those up and you should get to 31. If you don't, then you got to go back through those line items and say, okay, well, which transaction did I kind of screw up? And the one that I find that students struggle with the most is at the very end. So say with this example, say your last transaction happened on March 30th. Well, then you go from March 30th down to April 3rd, which would be your next billing date. And then those would be your days outstanding. So don't forget those final days at the end. Once you multiply your balance times the days outstanding and you get that total, you will add up your totals and then divide it by the 31 days or however days are in that month. And that is your weighted average daily balance. And then that's what they're allowed to charge you finance charges on. So then whatever rate they're charging you, you multiply it by that to figure out how much interest the bank is allowed to charge you. So the point of all the mathematics is just to say, like, say you started with $100 in your account, then you bought a bunch of furniture on the last day of the month for $2,000. It's not fair for the bank to charge you interest on that $2,000 for the entire month. They're only allowed to charge you for the days that $2,000 was outstanding. So that's what this mathematical computation is designed to do, is to make it a fair amount that they're allowed to charge you interest on.